Cancellation of debt income, or COD income, is the free money you get when a lender forgives what you owe. The general rule is simple. Canceled debt is taxable and goes in gross income. On the EA exam, they'll often cue you with Form 1099-C. That form may also tell you whether you were personally liable, which is your big hint for recourse versus non-recourse treatment. Here's the key split. Recourse debt means you're personally liable. The lender can come after you beyond the collateral. Non-recourse means the lender's only remedy is taking the collateral. On exam questions, look for phrases like personally liable or lender can pursue other assets. If you miss this step, you'll put the wrong amount in COD income and the wrong amount in sale proceeds. Foreclosure or repossession is treated like a sale for tax purposes. That's the weird part the EA exam loves. But the sale price depends on the debt type. With non-recourse debt, the amount realized is the entire outstanding loan balance, even if the property is worth less. With recourse debt, the amount realized is generally the property's FMV, and the leftover can become COD income. Let's anchor it with numbers. Non-recourse example. Loan balance is $170,000 and FMV is $140,000. Because it's non-recourse, there's typically no separate COD income. The selling price is $170,000. Then you compare that to the property's adjusted basis to find gain or loss. If it's personal use property, a loss is non-deductible, but you still compute it. Now recourse. If the loan is $170,000 and FMV is $140,000, the deemed sale proceeds are $140,000. The difference, $30,000, is potential COD income because you were personally liable and the lender forgave the shortfall. Then you still compute gain or loss on the deemed sale using FMV minus adjusted basis. Two buckets, sale gain or loss, plus COD income. Where does it go on the return? For non-business, personal debt, COD income is generally other income on Schedule 1 of Form 1040. The deemed sale piece goes where sales go, often Form 8949 and Schedule D for capital assets. And remember, personal use losses aren't deductible, even though the foreclosure is treated as a sale. On the exam, they're testing placement as much as math. Finally, exclusions. COD income can be excluded in certain cases, like bankruptcy or insolvency. Insolvency is a balance sheet test. Liabilities exceed the FMV of assets at the time of cancellation. If you're insolvent by $20,000, you can generally exclude COD income up to $20,000. When an exclusion applies, you typically report it using Form 982. The exam loves an insolvency worksheet. All of the following types of settlements from lawsuits are taxable income, except which one? Settlements for loss in value of property that are less than the adjusted basis of the property, interest on a lawsuit settlement, an unlawful discrimination award, or punitive damages. Think about what's income versus a return of your own capital. The correct answer is the settlement for loss in value of property that's less than the property's adjusted basis. That's generally a return of capital, not income, at least up to basis. A tempting wrong choice is the discrimination award, because people assume damages are excluded, but most discrimination awards are taxable unless tied to excludable physical injury rules. Ethan and Sophia are married filing separately and don't live together. Ethan sells stock at a $4,000 long-term loss. 15 days later, Sophia buys the same company's stock. How does Ethan report the sale? Wash sale disallowed, deduct the full $4,000, or deduct only part with a carryover. Think about the wash sale window and spouse purchases. The correct answer is that Ethan has a wash sale and cannot deduct the loss currently. The wash sale rules apply if substantially identical stock is acquired within 30 days before or after the sale, and that includes acquisitions by a spouse, even on separate returns. The tempting wrong answer is deducting $3,000 with a carryover, but that's only after you have an allowed capital loss.